Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm joined by Kevin Cook, Zach's senior stock strategist, to talk about Chinese stocks. What's going on with them? Should you still own them? Should you sell everything you've got? What should you do? And we have a little bit of experience with this in our own portfolios and the Zach's portfolios. So we're going to head right into it. So Kevin, this is becoming a big issue now about what to do if you own Chinese stocks. You know, should you be selling here?
Well, as a matter of fact, Tracy, I did yesterday.
Okay.
I got rid of my two favorite Chinese companies, Alibaba and Baidu. And I probably should have done it 2 weeks ago, but I didn't quite see the writing on the wall. And looking back with hindsight over the weekend, I now see the Didi IPO as the epicenter of what's going on now.
Okay.
Didi is the giant ride-sharing service in China, like Uber. Symbol is DIDI. They IPO'd in New York, like the end of June, maybe June 29th or something.
Okay.
The stock was up in the teens, $16. And then Chinese regulators basically started clamping down on them and making them shut down their apps.
Right.
And the stock cratered. I think the stock is now cut in half from where it IPO'd. It's definitely under $10. And there's several reasons that regulators did that. But I think it was sort of a watershed moment where if you didn't think that Chinese regulators could come in and destroy a company or a stock, you just got a wake-up call. And I should give credit to you, Tracy, because you've been warning us about this for 3 years. What was your experience? What happened with Tencent? When was that?
Right. I own Tencent in my own portfolio. So that's ticker TCEHY. And for those who don't know, Tencent is the Facebook of China, basically.
HY, right? TCEHY.
Yes.
Yeah.
Sorry. They're the Facebook of China. And so I wanted to own that, right? If I can't own Facebook over there, I want access to that. And they're also big in gaming, media, and music. So that covers the whole thing. So everything was looking good. You know, they're growing the earnings, they're growing their monthly active users, all the things. But then suddenly in 2018, the government decided they didn't like the recent release of a video game. Like they literally was one of their big games of the year. They put it out, and like 2 weeks after they put it out, suddenly the government said, no, we don't like this, and you have to withdraw it from the market. And
was it like explicit content or something like that?
Well, they claimed at the time that there were several things going on in China at the time. So 3 years ago, more people were apparently gaming and were like internet addicts on the games. So, where they would go in there for like 20 hours in like an internet cafe and got addicted or something. So they used that as one of the reasons. And then also like violent games. So they were trying to say like the culture was, too violent. So they wanted them to withdraw this particular game. But Tencent obviously had no choice. It just withdrew it immediately. But it was their big game of the year. But that was a real wake-up call to me as an owner of this business that, hey, the government can just step in at any time and change their business model. Well, that's a little scary for me. And that's not necessarily something I want to own when it's that easy for them to do that. Like, and at the time, I got into a lot of discussions online on StockTwits and Twitter with other Chinese investors when I said I'm selling out of all my Chinese stocks. That was the only one I owned, though. But if I owned any others, I would have sold those too, because.
And you definitely weren't buying them for your Zach's portfolios.
Right. I did own some in the Zach's, but I got rid of them around the same time as well. And I have not bought any others because it's like this huge risk. But they would always argue, well, the SEC or, the antitrust or Congress can make like some new regulation that also hurts like American businesses. So what's the difference? But the difference to me is that we don't have Congress just stepping in and saying you have to withdraw or stop providing that product like immediately. Like it just doesn't happen like that. There may be a long drawn out process where things get regulated a certain way, but it's not just, the White House or something like that just coming out and saying, no, you can't do this for your business.
Right, so right. It's not capricious. And in the case of the Chinese Communist Party, it could definitely be capricious and come out of nowhere.
Right, exactly. So I did sell Tencent for a loss at the time, but it wasn't as big of losses as what's happening now in some of these stocks, actually. But
yeah, I see in 2018, it got up to a high of 60, and then it was just a straight downtrend for a year down to, into the low 30s in late 2018.
Right, because of these issues of, the government being concerned and trying to kind of, control where they were going. Now you can see like gaming is still, I looked this up, gaming is still a huge percentage of their business now. And it's about half. In 2020, it was about half of their total revenue. But international gaming is really, really small percentage of overall gaming revenue and and obviously of their overall revenue because of what the government is basically doing now and keeping these companies, what I believe to be like, basically domestic entities. They are.
That's the thing. When we peel back the layers of this onion, it gets more complex. And that's why it really caught me by surprise in the past couple of weeks. Because if we back up and just talk about the U.S., remember the U.S. Came up with these new regulations last year where we were going to hold foreign companies accountable. In fact, it's called the HFCAA Act, Holding Foreign Companies Accountable Act,
right?
Where would require the SEC to prohibit trading of securities of foreign companies in U.S. markets after 3 consecutive years if their books weren't open, if we didn't have full transparency on, their balance sheets and income statements.
Right.
And there's this whole public accounting oversight board. So, but I thought, that thing's got like a 3-year window. And so the U.S. is not really in a hurry to delist U.S. companies. But what we just saw happen is that China was willing to basically do it themselves. That's the other reason. Well, there are 2 reasons they were mad at Didi. One, I think that Didi did not have permission to go ahead and do an IPO in New York.
Right.
And they basically looked at it like, all Chinese companies are doing it. We'll get away with this. And they sort of did an end run around the Communist Party and went ahead with the IPO. So here's the China Communist Party basically, slapping their wrist and saying no. And the other thing is that the regulatory authorities in China tried to say that this was about data privacy, that they were trying to protect Chinese consumers because, the Didi ride-sharing app would, if somebody hacked it, you'd have all this data about Chinese roads and consumers. But you and I both know better that when China says something like that, what they really mean is they just want to control the data. They're not trying to protect consumers because they'd be the first to use surveillance and data in nefarious ways anyway, right?
Right. But all of that data, as well as obviously the economic data you'd get from having the books be open and transparent, like what parts of the country uses more rideshare than others, like just little things like that might tell you about Chinese society and trends and all of that could be ascertained from having the books be open. They don't want that out. Why would they? They don't want it out with Alibaba. Imagine if we actually did get transparency in Alibaba's books or JD.com about the shopping habits of Chinese consumers and businesses for that matter. So that's too risky. They can't have that.
we should add, if this sort of Chinese stock story is new to anyone, some other background color. The big blow recently was when Alibaba tried to take their financial unit, which is called Ant Financial, and have one of the largest IPOs for it. It'd be sort of like Facebook or Google rolling out their own Square, right?
Right.
And that's how big Ant was in digital wallets, and the Chinese people are definitely very digital with their money. So the regulator stepped in and said, Jack Ma, no, you're not doing an IPO for Ant. And because they really wanted to clamp down. And you've done some research on this too. What is it about the sort of, does China have these cycles where all of a sudden the rich and successful, and now more so tech entrepreneurs, become billionaires, that they feel the need to clamp down on them, right?
Yes. Yeah. And they did it about 10 years ago when the governors of the various states were getting a little too rich off of the real estate boom and what was going on with that. And many of the party members were becoming billionaires, and their kids were wealthy, and the kids started buying things that expressed that wealth, like Ferrari cars or Rolex watches and things like that. And the head of the party, they had to clamp down on what was going on there, because it's just like another center of power, basically, that could be developing inside. So, and they did. They clamped down on all of that. People went to jail. Suddenly, there's not much talk about people like driving the Ferraris around, even though there are Ferraris there still. And that was any kind of risk to the party. The head party leadership was removed about 10 years ago. And now we have this kind of similar rise of these powerful tech companies, also with a lot of money involved, and popular personalities like Jack Ma, who was known in globally, but was also a big hero within China. He had his own business school. He had like a best-selling book. People like idolized him like they would like an Elon Musk or Jeff Bezos or any of our big entrepreneurs.
Oh, so that's another thing. It's not just that the tech billionaires became rich; is that also they were adored more than the leaders, right? Yeah.
So that's also a risk, and that had to be dealt with as well amidst all this. So, and then also there's just a fact of a big IPO, another big one like Ant. Once it's out there and once you're doing business in, foreign countries in a big way, it's not as likely that the Chinese government would just shut that down like that. Then that becomes, more of like an embarrassment or something if they had to do that. Like then that goes to their like international reputation. So you have to stop them from getting international and keep it domestic in order to keep the control, is what I think. So even like 5 or 6 years ago, Amazon made a big investment into India. They decided that India was going to be the next big consumer market. They couldn't get into China because they were blocked from going in there because of Alibaba and JD were in that market, and the Chinese would not let Amazon in. So India was considered the next big, competition for those consumers. So they put $5 billion in. They rolled out, distribution, like everything that they do, the Prime, all of that. And everybody, including myself, thought, this is where you're going to see Alibaba or JD.com and Amazon go head to head. And who will win India? Well, here we are, 5 years later, and there's no doubt who's won India. It's clearly Amazon. But Alibaba and JD.com weren't even really in the game. They gave up like years ago. There is Alipay and some things like that go on in like Southeast Asia and stuff. But for the most part, like for sure on, consumer products and shopping and all of that, outside of China, they have totally given up on being competitive on the global stage. But that's because that's basically being mandated from above. So now Amazon has.
Why do you think that is? Why do you think that China wouldn't want their companies to get a foothold in India? Is it again we don't want our information out there for everyone to see?
No, I think it is just a matter of if they were successful in India, then how do you control that?
Oh, I see. Right.
Because you can't suddenly be like, we're deciding to shut down the whole India division. Like once it's established, no, you cannot. And so then it gets to be a little bit away from you.
So again, it's we can't let our tech companies get so powerful that they're more powerful than the Communist Party.
That's right. And you look at what's even happened here. I don't think it's coincidental, but I'm not obviously a Chinese expert, so they'll have to tell us. But I don't think it's coincidental that you had Facebook and Twitter ban the former president from the platforms, and now suddenly we're seeing this, crackdown on their tech companies and an assertion of control because they've seen what's happened here when you don't have control, basically.
So I said I was late to selling, like I really should have absorbed this Didi news quicker about 2 weeks ago.
Yeah.
You know who else was late? Cathie Wood of ARK Invest.
I did see that she's now selling, right?
Well, yeah. Last night, so I sold my positions yesterday while the market was open, and then I sent my alert out to my people. I sent my alert out, or not my alert, my summary, my evening summary, explaining again why I sold, and then about a half hour after that, I got my ARK daily summary. That's the one, not the one. That's one of the cool things about Cathie Wood's transparency with an active ETF. She sends out a daily email. Hey, here's what we bought and sold every day. It comes out about 10:30 Eastern time, and big wipeouts in positions. Let me look at Tencent here. Tencent was 630,000 shares sold.
Wow.
Baba, I see one trade here for 100,000 shares sold. Baidu was in here. I think there was another big Baba trade, and then a JD trade. 651,000 shares of JD sold. Wow. So she finally made the decision. Yeah, this is you can't have any confidence in your ability to invest in these companies right now.
No, and because you are buying the business if you're investing for the longer term, not trading them, but investing in them. And nobody knows what's going to be the next shoe to drop. I mean, you mentioned that news about Tencent over the weekend, where that was for Tencent Music, which is also a separate ticker. They spun that off. What is that ticker? TME or something, isn't it?
Oh yeah, I forgot that's a separate public company.
TME is the ticker. They haven't been trading that long, really, but it's down another 7% today when we're recording this on July 27th. But
it's taken the mothership down 16% in 2 days, Tracy.
Wow. Okay. Yeah. I mean, that news just kind of came out of the blue, and so you don't know. We've had the news about reining in the online education companies. That's also.
Oh yeah. Right.
Those have all been hit really hard.
That was the big blow on Friday. Like TAL Education was down over 60%.
Yeah.
Because they all of a sudden came in and said, they're totally revamping any ideas of an education model.
Well, the entire business model.
Yeah, just destroyed that business.
Apart. Yeah. So these are the dangers that are out there for more than just like Alibaba and that. I was taking a look at Trip.com. It used to be called Ctrip, which is like basically the Expedia of China. And it's like partially owned by Booking, which was Priceline. So Booking owns a huge chunk of it because they bought it to have exposure to the Chinese consumer, and it's down 28% in the last month on all this stuff going on. Now, nothing has been announced or said or done against the online, companies at all, but these are the ones that are a question. Should you be holding on to these when nothing is happening with them, or do I just need to sell everything?
Well, that's a really good question, because on Friday when they when they took the action against the education companies like TAL, and that stock was down 60% right away, I thought, oh, Baba and Baidu, they're only down 5%. So they're not going to be, they're only going to be small collateral damage here. They'll be fine.
Right.
And, you give me one, by Monday I was saying, no, this is bad.
Yeah.
So do you think that, here's what I have trouble grasping is, I said to my people over the weekend that it's like if the Communist Party will eat their own, if they're going to eat their own children, their companies, then anything is possible. How far are they willing to go to really hurt their economy here?
I don't know. That's a separate question, but does anyone really think the party makes the good economic decisions always? The same thing could be said of the Fed and all of that too, but that is the question, right? I've never known a government who could actually get that right at all times. So that's why I don't trust any of it, even with the big caps. Because I used to think that they chose their winners in these tech areas. So they chose Baidu originally years ago to be the winner, to be the Google of China. So any other competitors were like, sorry, they assisted these guys to get big because they wanted the Chinese equivalent to the Google in their country. And it worked. But I always thought they would, ensure that they stayed the winners and even possibly globally be winners, because that's the American model, right? We want our companies to be the global winners, and that's kind of what we do.
As you pointed out, like, we get to invest in the stocks of an Alibaba or a Tencent, but they're not dependent on foreign sales. No. Right. So that's sort of the difference. I guess the Communist Party realizes we're not losing by punishing these companies. We're not losing any foreign sales. We're just gutting investor confidence in their ability to buy the stocks. And we already have proof that they don't care about that. I think you follow what's her name? Therese Paletti, who, she's like you. She's been writing about China stocks for years on MarketWatch. And she reminded me of the example of KeyHu. Remember KeyHu?
Right.
That they basically trashed the stock for hard to figure out reasons. Because I know, because I was a shareholder and it seemed like everything was right about the growth of KeyHu. But they kept trashing the stock, and then they end up taking it private, take it back to China, take it private, and then do a new IPO there. And the people who did that, the sort of noble class of China who was allowed to do that, ended up making like 5 times their money on basically debilitating the stock, taking it private, doing a new IPO, and cashing in. Yeah. So maybe they're willing to do that with all these companies.
Well, Alibaba went private once, and then
that's right. I forgot about that.
Yeah. So they've already done it too. Like, these are all the issues that are kind of out there. And I know some investors will say, I know these issues and I'm willing to risk it. I'm willing to stay in because I still feel like these are good businesses. But my problem with that argument is if some of these only stay domestic only. So for instance, I looked up Tencent to see what was happening with WeChat and Weixin. That's the Facebook part of the business. And as of the end of December 2020, so the end of that year, they had 1.225 billion monthly active users. But that was just up 5.2% from the year before, because basically at 1.225 billion, they're reaching the end of where they can find some more monthly active users within their own country. So what happens to that business? How do they grow? It's not all about the monthly active user, because it's about the revenue you're getting from each of those. But without being able to grow at all the monthly active users, I'm not sure I want to own that business at this stage of its development. 10 years ago when it was like growing that at like 30% every year, that's a different story. But everybody, always wants to buy China to get access to its huge market. But these big businesses already have tapped at that. They're already mature businesses.
Yeah.
Oh, I don't even consider them to be deals here on the sell-off with the other risks that we've already.
Yeah. Not when they could take them back home and take them private. I mean, that's
right.
In this Therese Paletti article on MarketWatch from July 24th, it's titled "This is Your Final Warning: Chinese stocks listed in the U.S. are dangerous to hold." She talks to a lot of pretty smart people in the know, and there's a professor at Harvard, I believe, Jesse Fried, I think is his name, and he shares this one opinion. I want to read this because it sort of tells you what the landmine you might be walking on. He says, "My gut sense is that China will try to reach some accommodation with the U.S. government. For now, China wants to keep the U.S. markets open and available for these young Chinese companies, which China's undeveloped capital markets cannot adequately support." So this raises a question for me. Obviously, New York loves the China IPOs, right? Because that's IPO money for the big banks.
100%.
But what I can't wrap my head around is why China's capital markets would still be undeveloped. And the reason I say that is because I've been working on trading floors for 25 years and watching how fast technology developed in New York and in Chicago. And it's always been so easy for China to copy. And in fact, China has alliances with U.S. exchanges. Like, how could they have undeveloped capital markets that couldn't support their own IPOs? That's what I don't understand. What do you think about that?
Well, I guess they're assuming that there's not enough Chinese investors who would be diving into all of these. They don't have the firepower.
It seemed like there was a craze though a while ago, wasn't there? A few years ago, the Chinese retail investors were going crazy, just like sort of the meme stocks here.
Yeah, that was the case. They did have like a mini stock bubble a couple of years ago. But if you're taking some of these, public at 10 or 20 billion, some of them, they must just not have. I know that she said in that article, there's 248 Chinese companies on U.S. exchanges, and for 2.1 trillion. So they really don't have the 2.1 trillion to back it. They don't.
Yeah, they must not have the sort of infrastructure that we have with investment funds. So where you have these, you got a Capital World. I mean, obviously Fidelity and BlackRock are huge supports for our markets, and they don't have that.
Yeah. And another thing that investors should be aware of too, which I wasn't until about 3 weeks ago, is that you may own a lot of these Chinese companies in an ETF or a mutual fund and not even know it.
Right.
So I do recommend people go look and make sure what they own, because 3 weeks ago I was looking at my own 401k, which I hadn't looked at in a while because I know what it's in, but I didn't know what it was in. So I owned a mutual fund in it that was a developing market mutual fund. And sure enough, when I was like, what does this own? It was about 40% Chinese stocks. And so any of those in those types of funds, it is going to be Chinese stocks.
Yeah. Anything emerging markets. Yeah.
Yeah. And so I did sell it 3 weeks ago and just redeployed the money somewhere else. But, it wasn't performing well by any means, even 3 weeks ago, because of the huge concentration in Chinese stocks. So if you really don't want to own any, it's kind of hard, because if you own any international type of fund, but in that one in particular, it was way overweighted in the Chinese, so I had to sell it. Another way to get access to Chinese consumers and that market over there is to own American companies doing business over there. But there is risk to that too, as we've also seen that recently with Nike. So remember, there was some kind of like social media campaign against Nike a couple weeks ago, where the consumers were like, don't buy Nike for XYZ reason. I don't remember what it was, but there was concern, and Nike had to release a statement saying, no, we're really for this, or whatever it was. And so there are these risks still over there of American companies doing business in China that you should be aware of. So that would be, Starbucks, McDonald's, Nike, Lululemon, a lot of the retail names, Capri, a lot of these have business in the country that could be impacted as well going forward. So you should just be aware of risks, but everything has risks. Every company has risks.
I mean, I remember a couple of years ago, the biggest risk to me for emerging markets seemed the trade war. Well,
yeah,
what this action lately by China kind of dwarfs that.
Right. This is much more severe, I think. So yeah.
So I guess if you want access to the largest middle class in the world, you just buy Starbucks.
Yeah, kind of.
Or McDonald's, or maybe Tesla's doing. I think Tesla's doing well in China.
Tesla's another one. Yeah. Yeah, there is way to get exposure without actually buying the Chinese companies. So are you going to keep like Baidu and Baba like on a watch list and like kind of see what develops and like re-evaluate, weeks or months ahead, in the future to see if maybe you could buy them again?
Yeah, of course. I'm always interested in those two because I mean Alibaba really is the Amazon of China, and they're expanding into the cloud and data center and providing those services for other enterprises.
Right.
And then Baidu is just so heavily into artificial intelligence and autonomous driving. They sort of have the golden key from the government to do all the testing for autonomous driving. So, yeah, I'm going to keep watching them. But if the Chinese government tells you, hey, our companies are not investable, I'm going to listen to them.
Okay.
And I'll just have to watch them from a distance.
Yeah. Okay. Well, that's good advice. And I think, we're going to see some more things probably happening from.
Yeah. I mean, this could go on for, at least another 18 months.
Yeah.
And when the dust settles, there'll be some people who make some real money who buy on the way down. And then when it turns, maybe it turns fast. And all of a sudden, all these stocks are back up 20% in a week. But that's, you could take that risk if you have really good research to inform you, or if it's a small percentage of your capital. Right.
Good advice there too. Okay, so I think we've covered everything for now. We'll have to revisit this issue.
Yeah.
I'm still not owning any, and as the value investor here at Zacks,
only I had listened to you, Tracy, 2 years ago. Although I did make some good money on Baidu for a short-term trade. I was buying it under 140 last year, and then all of a sudden Kathy Wood just started buying it like crazy, and we had this bubble. Baidu went to 360. I was lucky to take some profits above 300, and then I only took like a 12% loss on my most recent trade, so I really can't complain.
Yeah, no, that's not that bad. And another thing, I cannot own any Chinese stocks in the insider trader, just FYI. I never could because we don't know if anyone's insider trading.
It's very shadowy there.
Right. So that was also one of my complaints over the years, is that they should have to disclose, what Jack Ma is doing with his shares the same way we need to know what Jeff Bezos is doing with his. So I hope, that some of that does come into play moving forward to make it more transparent for investors to know what is going on behind the scenes. So, okay, we mentioned a lot of tickers on today's episode. Tencent is TCEHY, so let's get that one right. Alibaba, BABA. Baidu is BIDU. Trip.com is TCOM. Tencent Music is TME as in Edward. Didi is DIDI. TAL is TAL. We mentioned Kathy Wood. That's in our ARK funds. So ARKK is the innovator one, the oldest. And I think that was it.
JD?
Oh, JD, sorry, can't forget them. I guess that is it.
Yeah, those
a lot
all
of stocks.
Look at their charts this week, and it tells the story.
Right. And it'll be an interesting thing to watch going forward, as we said. But as always, you want to be sure to subscribe, because who knows what we'll be discussing next week here on the Market Edge. And you don't want to miss a single episode. So get us on Apple Podcasts. We're on Spotify. We're on Amazon Music. We're anywhere you can get the podcasts. But be sure to listen in, and I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.